ready?
Yes.
Team, we ready? All right, video man. Okay, let's call to order the CalHFA Audit Committee meeting. How about a roll call?
Mr. H.E. for Treasurer Mock.
Present.
Ms. Sotelo.
Present.
Mr. Gunny.
Here.
We have a quorum.
All right. I know it's been a little while since we've met. Seems like we were gonna meet and got postponed and shifted, and one time you weren't in town, so it's good to get everyone here. I think that's really all my comments, and really turn it over to Lori or Dawn. Do
Okay.
you guys have any additional thoughts you want to add before we get going?
No,
No,
just
just
glad
go
today's here and that we're going to be reporting on the results of the Housing Finance Fund audit for the June 30th, 2018. Next to me is Mandy Merchant. She is the principal for Clifton Larson Allen. We have some wonderful things to go over with you today, and we'll get started.
Great, well then, why don't we do approval of the minutes? If you guys had a chance to look at the minutes?
I have. I move approval.
Joe Vaughn, yes,
I have not, but I'll move a second and trusting the great work of staff.
moved and seconded, so by acclamation, we approve the minutes. And with that, let's get into it. Item number 4. Mandy, are you kicking it off, or?
You good? Okay, all right. Well, hello everyone. I am back for another year. Thank you very much. I apologize, I was not able to make the other meeting that you had. I did have some other conflicts in place, so I appreciate. I do like to be present at this meeting and be able to present the work that we all have dedicated ourselves to the past several months this year. So I do have a handout for you all. In addition, you should have a copy of the CAFR, which will we'll highlight a couple things. You also have a copy of the single audit report, a letter that we do to those charged with governance, which will be you all, and then also a management letter. So we will go through that as part of this presentation. So first of all, just kind of opening up the handout that I gave you. I did a refresh on Meet CLA. There was one thing I kind of wanted to highlight on this for you all this year. We now have 9 offices in California. I don't know if you guys remember, but when we first started with you all, we had 1 office.
Yep.
And we've had a lot of success and a lot of growth out here in the California. So we're expanding up north with our new Sacramento office, and we're slowly going down LA.
State business?
Up here in this area, the Galena was the other firm. They do a lot of state and local government. Yeah, they do a lot of like counties and stuff like that out here. And then down in Glendora, they do a lot of transit authorities, stuff like that. They have a little bit of government and nonprofit practice down there. So and then we still have the original office that's like kind of forensics litigation. That was kind of like the
Growth by acquisition?
Yes, growth by acquisition. So, but it's been good. So I did want to point that out for you all that we are growing in the state of California. You were our first first client out here for CG. So.
I hope you remember that.
So look, we're spreading like well, yeah, still around. So, and then on the next slide, and just so you see that all the bikes of Mr. Gunny pointed out, we did go through a rebranding, and we're using the bike as our new branding, like showing, riding together, places to go. We feel that it's something to show that we're always moving, always, going towards the future. The rockets, again, are just helping everyone grow. So it was a big spearhead they did to kind of change all this. So, all right. And also in there, I just wanted to see your engagement team again. This is actually second year for this engagement team. This is Iffy's first year. So you still have Liz, senior associate, Lexi, Iffy, and Joey. We're actually planning out the team this year. Everyone actually will be back. We also will have a manager this year that's going to come on board to help me leverage. So Gabrielle or Gabby Miller will also be the manager this year. So everyone's being kind of locked down right now, but so far it's the same team. And Liz and Iffy were just out here for the insurance fund, the Fannie Mae. So they just worked on that last week actually. So, all right, so let's get into the real stuff. So the CAFR. Just to kind of highlight the CAFR, this being the second year of the CAFR, The biggest thing is everything's relatively the same. You have the letter transmittal, the audit report, MD&A, all the supplementary. This year, what is different is the GFOA award. So last year this was not because you hadn't gotten the award in here. So I meant to tag this. I apologize for flipping through pages, but that will be on page 11. So that's your first award. So each year that'll be in the report now. So that's the only difference from the prior. So if you go to page 11
of the report.
yeah.
Oh.
Wait a minute, yeah. Right there, so.
Yeah.
That is the what you will see every year for GFOA.
36 of the package.
Yeah, so. And then if you turn the page, we are then gonna go through the balance sheet or the statement of position and do some, talk about the overall highlights, the changes. We'll just look at the changes in 2018 and 2017. And as you see, we do have 3 years presented, but if you go over to the change column, you will note some of the changes, the decreases and increases that occurred during the year. This is just the assets on the first page. And then if you flip it over, you would then see the liabilities, and again, showing the increases and decreases in the 2018, 2017. So keep your fingers on those 2 pages and then go to the page 7. So this is where we kind of talk about the analysis of the change. So I think the first one that kind of sticks out is the decrease in cash and investments during the year. So in here, you obviously you guys are paying down your bonds, so the early bond redemptions are outweighing any kind of bond issues. There was no bond issues this year, so basically it was just a pay down on that this year. So that's a big decrease in that money. You can also see that your notes receivable, your programs loans receivable, which on the balance sheet, you have to grab the current portion of the 59 million and then also the 90 million in the long term. And you see we got about $150 million decrease in that. And that again, that's principal repayments and then some prepayments. And if you have the CAFR, just so you guys can see, 2 notes in here that I find are really helpful to see everything that went on is if you turn back to page 42 of the statements, which will get you to note 4. It looks like this.
So so we have two numberings in our package. There's a
The financial stage, the
Okay.
financial page,
So the
yeah.
financial, okay.
Oh, I see what you're looking up top
Yeah.
there.
So
Got the
42 of the
PowerPoint
report.
in.
It's
Yeah.
page 67.
They didn't give me that
Okay,
fancy
there we go.
packet.
Okay. So it's
So-
67.
This on here kind of shows you what I was just talking about. You can see how the activity of the programs, notes receivable started at the 2.6 million in the beginning of the year, and you can see, the loans purchased during the year. That would be the soft seconds that were purchased, and then you can see like the prepayments and the normal reduction. So I think this is always a good footnote to kind of see the activity that's occurred during the year. And then if you were to flip just a couple more pages back, and we're gonna go, because we'll talk about 2 more things. The decreases in the bonds this year is back on page 58. And again, at the top of this footnote,
Maybe
83.
83.
83 in the packet.
so you can see the top of that where we talked about the bonds, and you can see how this year there was no new bonds issued, versus last year, and you can see the continued pay down. So I also think those are good notes to kind of look at, just for you guys at home and on every year, since that is like really the big activity that occurs here. There's always like nice notes to go to. So, all right, so we turn back to the presentation. We'll continue to go through that. We just talked about the bond decrease. You did have an issuance of some notes payable this year with FHA. So that was about $100 million increase of some new product that you guys sold this year. And then lastly, your other liabilities increased. This year was the implementation of GASB 75, which is the other post-employment benefits. So that was something that was, communicated by CalPERS. That was the reason the delay in the audit.
Right.
You won't go into that. This is public. But that's a very tough implementation this year. A lot of agencies were a little behind getting this to work out. So this resulted in the $12.7 million increase in the other
Can you
liabilities.
just explain that to us, why there was the increase, what led to the increase?
Well, because last year was basically zero. So this year, and you don't actually
Liability.
you don't actually restate for this GASB. So basically, they have the zero beginning of the year and the increase of 12.7. So the actual, hold on, let me see something real fast. The prior period amount was, I don't know off the top of my head. If they had implemented,
So point of clarification is that the liabilities always existed, but it just has not been.
Wasn't
Right.
required to report
Reported
it.
financial statements.
so basically
That's-
if you had been on the prior year books, it would have been $47 million. Basically, was the true beginning balance, kind of bring it into. So that's kind of like the increase that has occurred. So.
And remind me what it is, the gas?
So it's the healthcare costs that are paid after retirement
Oh, okay,
for employees.
okay, and before we would need to carry that as part of the audit to reflect our liability.
They call it pay-go.
Pay-as-you-go.
Pay-as-you-go, yeah.
So
Now-
now we're reflecting it in,
Yeah, there was a statute that required a change, that it actually be, was it a statute?
The gas,
Gas.
yeah.
A
Federal.
rule that
Yeah.
said you had to start reporting it in your financials before that.
Yeah, and you,
so that we can see what the
required to.
obligation is and then
Yeah.
not
Yeah.
spend beyond.
And I,
I was gonna say, you guys don't really have any control over it. You know, CalPERS kind of hires, the actuary and does all that stuff. And so they determine the assumptions, all that kind of works together. So then they come back and provide you all with what the liability is for yours. And I think you have a
For
little
the
bit.
state, for the state,
For the
and
state.
then we have to wait for the controller's office to
Give us our-
break it up into each one of the funds,
I see.
and that's the report we were waiting for.
Right.
And as we're doing our staff planning, I'm sorry, Mr. Chair, can I ask a question? As we're doing our staff planning and, we're looking at, the work program that we had and discussed at our last meeting, we're gonna get more annuitants or, more retirees. So that's gonna increase and we'll know ahead of time how that increases?
I think that is a formula that Department of Finance uses, so I don't know that it's based, what is
On
that?
actual retirees?
Actual retirees for the state, the actual cost paid out to retirees. Again, it's part of the,
But it's overalls, I'm just having difficulty whether it's our staff.
no, it's
Or
not
it's everyone?
specifically our staff.
Oh, I see.
It's,
No.
it's,
That's what I'm having trouble.
it's overall, and
Okay.
then they use a formula
Mhm.
to determine how much each department or agency or fund pays as their proportionate share of that overall.
Regardless of how many retirees we actually have
Yeah.
and our obligation.
yeah, if it was like
Right,
a
and-
local government situation, you would have an actuarial study done, or
Interesting.
CalPERS would provide you your specific employee makeup, but I think the state does it on a
The state
statewide
doesn't
basis.
do it like
They
that.
did, and what they used was pensionable compensation.
Right.
So the pensionable compensation for this agency was compared to all the other state agencies, and ours is a particular percentage, and they apply that percentage to the overall net liability,
I see.
So it's loosely tied to our.
loosely
Yeah.
tied.
Yeah,
but not-
and because our pension is higher than probably other state agencies, we carry a larger percentage of it. Okay. Thank you, I
And
appreciate
that was part of the
That's a good
reason
question.
why we had the holdup.
Mhm.
I'm getting our audit completed, because it was that component that we were waiting for the state controller to provide us with that number so we could finish the audit. But
Right.
everybody was in that
Right.
situation.
Mhm.
And
So-
I don't know if you recall, but I would say several years ago, there were adjustments to our financial position related to just the pensions themselves, because there were announcements that were put into play too. They've sort of been timing these over the last,
Right.
I don't remember how many years, you probably know exactly.
About, is this 4 years ago?
Yeah, 4 or 5 years.
So will it be more, have they determined, will it be on a regular basis now, or will they be late again next year, I guess is what I really wanna ask.
I don't think there's any other, other kind of liabilities out there. We'll talk about another thing in the back, but I think kind of like these legacy, kind of these long term. I think we kind of got them all. I'm sure there's something out there they can figure out.
We hope.
It's nothing
I mean,
coming to
it's
my
all-
head right
it's
now.
all dependent upon when CalPERS gets their audit completed.
Mhm.
And then there's time that needs to go through the SCO.
Mhm.
So, and I think CalPERS reports on 12/31. So, or they have until 12/31
Right.
to produce their
Their
financial
audit.
statements.
Mhm.
So really, it could be done anytime up through there, and then they need time, the state controller's office needs time to allocate our share to us. And then we need time to put it in and do all our tables and disclosures.
And it's such a big number that you're not really in a position to project it and then clean it up in the next audit. You really wanna have the actual number.
Yeah.
Okay. Any questions on the balance sheet? Is there any other number,
What page you on?
of the presentation? Page 7. You're right. Okay. Well, then we'll flip over to the next page, page 8. It's the statement of revenue expenses and change in that position, basically the income statement. And again, you know, the first thing I always like to do when I have an income statement, I go straight down to the bottom, look for the increase, decrease in the net position. So you can see this year you had an increase of 211, million, and then versus last year the loss. So if we turn that over to the next page, page 9, you can see where we kind of talk about this. So we talk about the increase this year in the net position, and a couple things that highlighted that increase. 19.6 million decrease in interest in the program loans. Again, there's fewer new program loans that are being issued. We already talked about there's been a lot of pay down in the debt and pay down in the program loans receivable. There is increase in other income. So the 13.6 million, this, the new thing that your agency has been focusing on is the TBA market. So this is all the income that's coming in for those loans that were, packaged and sold out this year. Interest expense decreased again, less interest expense when you have less bonds to be paying on that. So that's correlates. And then finally, last year was the big transfer out of the Senate Bill 837. It was a bunch of those programs that were transferred off the books of the finance fund.
Here's your notes.
You have mine. I was just looking at that.
I was like, I think I have Amanda's notes.
I was looking for
She was
some
doing so well without them too, right?
That's so helpful.
Yeah, I know they were so helpful. I was like, oh, I'm following right. I was like, that's not my handwriting.
I was like, who has it?
Sorry about that.
Thank you for bringing us back to that.
Okay, you're right.
So that's kind of overall what fell, just the decrease in overall stuff kind of help with the net, the net income coming up, and then overall net position going up. So does anyone have any questions on any of that?
So, just to Mr. Chair, just to put it in context, in 2017, we had a transfer out of 341 million. What, remind me what that was for?
The down payment assistance. Remember when we streamlined
Yes.
the various pots of DPA, and we had been carrying that on our finance fund, but we took all of those DPA programs, we consolidated and streamlined them and put them in the home purchase fund. And so that was,
So just
it wasn't a loss of money, it was just cleanup. And when we did that trailer bill that allowed us to consolidate our down payment assistance programs.
Okay.
But like Tia said, we still control the funds.
Right, you still have some,
Yeah.
and still on somewhere else in the world.
Yes.
Okay.
And that's what 837 allowed us to do.
Yes.
Yeah.
Okay. All right, so we're gonna turn to we could pass through to page 10, go to page 11. And again, kind of like every year, I kind of put together, update kind of where we are the 5 years. Put together a couple of the projections of looking back. So again, just basically what we've been all talking about, kind of, your swap liabilities, hooray, going down. Definitely not up to the 120 swaps I was looking at,
Yep.
7 years ago.
Boy, that was a pretty tall column.
It was a lot.
Back in 14.
Back in the day.
Please.
Again, this is, just attributed to the making the debt service payments on the bonds, any kind of par terminations that are available, you guys were taking advantage of them, and rumor has it you were trying to get out of these derivatives, so that's what I was told.
Yes, indeed.
And then, and again, with bonds payable, consistent with what you all have been talking about doing is paying down the bonds, issuing them, I guess the multifamilies, I'm not sure when you guys plan to issue another multifamily, but obviously the single families will continue to see go down if you continue to stay in the TBA market versus, issuing bonds. So probably see this kind of kind of go down some until you issue anything more.
And so can we pause right here for a little bit? This was all what we, the temporary credit liquidity program had helped backstop when we had variable rate debt and we were paying down
I
those
don't know
bonds.
that all these bonds payable are the VRDOs only, they could be the
A
fixed
mixture?
rate as well.
It's a
So
Okay.
I think the derivative swap liability on this side is probably closer aligned with how much of
Of the
bond
VR,
is
the
left.
variable rate debt, okay.
And I think if you remember from our workshop, I reported out, I think our VRDO balances are at 40.5 million currently, or at least at the mid-year mark. So
Okay.
that's pretty close to where this swap liability is.
So just by way of history, you all remember that 2013-14 when we started, we were in the temporary credit liquidity program. That was the program that the federal government came to help housing
Obama money.
finance agencies, especially because there was a credit liquidity program. Our credit ratings had gone down, and the ability to go get credit was tenuous at best. And so we were able to, through various financing strategies, paying down of the bond debt, and utilizing that program, we were able to get out of that variable rate debt, get out of that temporary credit liquidity program, increase our credit ratings, and this is just showing how we've continued to get financially more fiscally sound.
Yeah, and I can tell you, one of the footnotes, we have about 1.4 million in the bonds payable, about 87 million is the variable rate debt.
87?
And
Yeah.
that was at the end of June. of
Yeah,
2018.
June 30th,
So
yeah.
we paid down more, and we're at
So-
40.5.
Yeah, and that was,
Oh, okay.
that was 3.5 billion. Wasn't that the one that
Yes.
was?
Yeah, that was
this-
huge, yeah.
Let me be clear.
And now we're only 87
3.5
million.
billion.
Right,
Yeah, that's
right, so, just,
Wow.
yeah.
yeah.
Within
Yeah.
really 4 years. I
Yeah,
mean,
that's great. Okay, so if we go to the next page, page 12.
And just for the record, what is our rating now?
Yes, what is our rating now? Double
We
A?
are double A
Plus.
stable outlook with
Positive.
Moody's, and we're,
Positive, yeah.
yeah, we're A plus.
A plus.
With positive, with SP.
Yeah, A plus, positive outlook.
Mhm.
So we have that officially on the record.
I should have it committed to total memory, but it's like we got it for each of the indentures overall, you know, so it's like we got like 6 ratings, so. But they're doing very well.
So next time it's just the overall, just give us the overall.
Yeah.
Or give us the one that's the highest, right?
So the highest one, please. So the next slide is, again, just looking at the program loans receivable, and I know it's a small number, because obviously the program's loans receivable is small, or large, but you can see how the allowance is changed, but not by much, but you can see that the program loans receivable has gone down a lot more. You know, back in, I remember year one being here, how large your allowance was back in the day, and all your, foreclosures. So this is great, you know, everything's really, the stuff that you have in the portfolio is pretty strong. So which I think is how you enter the TBA market, you know, you can get in there because all these, loans are healthy.
Mhm.
Okay, so page 13, the single audit report. So that is the separately smaller issued report that should be in your packet. I don't know the page. I'm gonna ask for one of these packets next year.
232.
So as always, every year we are required, since we have over $750,000 in federal awards, to do a single audit. This year, the program's tested, we did this, the Section 8 project-based cluster, which is pretty consistent with what we do every year. Every year, you know, I always tell you a finding. I am happy to report.
Wait.
There is
Drum
no
roll.
finding this year. No finding.
No way.
Say
No.
that again, Mandy.
I know, just for emphasis. Thank
In the
you.
single audit report. I may have a comment, but we'll get to that. in a minute, so. But yes, it was a great year. Obviously, all the hard work from the staff for the past couple of years. Us putting in, trying to find something every year to put in there.
Make us
But this
better.
year we couldn't
Yeah.
find anything. We tried. We looked under a lot of
You know,
rocks.
we put in a lot of hard work though. Let me just
Yes.
pause right here for
Right
just
now.
one moment.
Do it.
So, it seemed like every year since I had been here, there was something going on in our Section 8 federal programs. And Delilah, and Delilah was on us. Where board member Stella was like, "What is going on?" And you guys need to go fix it. And so we literally brought in an outside consultant to review all of the processes and procedures and our asset management administration of we updated our policies and procedures. We worked hard with legal. We worked hard with fiscal services. We made sure that we had documented processes and procedures, and we had a plan, and then we implemented that plan. And so that is literally how we ended up getting here.
Training too?
We did training.
We did.
We were
We
serious.
aligned.
Yeah, I was serious. I was like,
Balance and
I don't
skills
want to
and
see
staff.
one more.
Exception.
No, yes, and so I think that was we all came together and worked that out. And so I'm very proud of asset management. So I don't know, Rose is here and our asset management and fiscal services, but they really did
Yeah.
come together and make that happen. So I'm
Yeah,
very happy.
congratulations.
Great job. It was a great job. So that was great to see that. And I know you guys went through so much work, really like dedicated to figuring out how to get rid of this finding. So, and then the same thing on the financial statements. Every year, we try, we look for something. Didn't find anything this year, but there's always next year.
We're gonna continue to try to just
We're gonna win another
be
award
well.
this year.
Yeah, we're going after the gold.
So, but all in all, it was a great job by all. So, so if you turn on to page 14, just going through the auditor communication letter, and that is another letter that you guys kind of have separately in your packet. And this is just kind of a very high level of the entire audit, kind of going through, accounting policies. There was a new GASB that we talked about already, that was implemented this year, 75. I think the most important part is the accounting estimate section for you all. Is just knowing that these statements do include estimates that management or an actuary / CalPERS has helped determine. So obviously your allowance for loan losses is an estimate. Your values of your investments, those are fair value, and then the derivative instruments are also included in there. There was no uncorrected misstatements, and there was no corrected misstatements as part of the audit. Obviously, we made a change for the 75, but that wasn't us. That was management did that. So, and then we do attach this is the management representation letter with Lori and John. Actually, Lori and Tia signed. How'd you get out of that? Put a third line on
We
it.
did like this, sign this.
Yeah, sign this.
T, I need your signature.
Just practice.
And then flipping the page to page 15, just the last, we did have one management letter comment, kind of circling back to the replacement reserves, our favorite thing. So this year, we did note, so one of the projects that we selected, the number 12 deposit that was for June 30th, 2018, there was some miscommunication and it got deposited in July. It was deposited July 6th?
Yeah, a few days after.
A few days after. So again, we didn't make it a finding because we could see it. We could see there was a time, but just again, making sure that everyone's aware of those 12 deposits coming in, and then to making sure if it's coming in, if they've sent it to you, getting it into and depositing into their bank account by that month that it's supposed to be recorded in.
So that was the issue. It was that you did a survey of, you just picked a project, and that project that you happened to pick had a delay in the
11.
deposit.
11 deposits. They're
deposits.
supposed to have 12 monthly. 12.
Yeah. But then we
And
found
the
out, which
project
is
came in late.
right after year end, so we were like, okay, we're not making a finding.
But it came late to us, or we would just.
It did not come late to us.
Oh, I see.
No,
I see.
it was posted incorrectly
Yeah.
and inadvertently was returned to the project. And then when they discovered it in their reconciliation,
Mhm.
their monthly reconciliation, they asked for it back.
Oh, okay.
So then it came back just like in the first few days of July.
Oh, that's good. So it's an actual check and balance,
Mhm.
and it actually worked.
Mhm.
Yeah.
So we were just testing.
Yes. and we would never give you a finding if they hadn't sent a payment in. You know what I mean? All we ask for is that you document, you have a process
How
in
you
place
do
to request, hey, you haven't paid your 12th payment. Where is your June payment? That's what we look for in that circumstance. But we would never penalize you guys because someone's just not following the rules.
Mhm.
And our detective controls are working properly.
Yeah.
And that's what that
Nice.
tells you, that
It does.
you have processes and procedures and checks and balances, and that it worked.
Yeah.
That's
Yeah.
important.
Yeah, so we have to put that in there. So that is it. So great report. And then the last thing, 16 what is coming in the future? GASB 87. This is my favorite. I don't know why. Big accounting nerd.
We're not gonna hold that against you.
Leases. Basically, what GASB is, wants to torture us all with this time around, is saying that we need to start accounting for these leases. Right now, it's basically pay-go, if you think about it. Especially on your side right now, you lease this building. You don't have any recorded liability on the books. It just, as a monthly payment comes up, you pay it.
Right.
So now what they're saying now is that we have to turn around and we have to put on an asset, a right to use, I think it's called right to use asset. And then you record the liability on the books. And basically you recorded present value of the future lease payments. And then you basically amortize them over the life, you amortize the asset over the life of the lease, and then as the payments come in, they pay down, as you put the payments out, they pay down the debt. So I actually have one client I've gone through this so far, I have another client I'm working on, but you all have 2 leases. Well, take that back, we didn't talk about copier leases or anything else that you're leasing.
Oh, it has to be
Anything
personal
over
property too?
1 year, anything that's got a lease longer than 1 year has to be put into
What
this,
a
Can I
nightmare.
ask a question?
or it can be a material.
Have they talked or provided guidance on how we're to value the lease itself?
Yeah, it's all in the standard.
Okay.
Yeah. So it's, for the most part, if you can wrap your arms around amounts, then you record it. If it becomes to be, so some of these leases can be a little bit, based, which you guys don't have, like based off sales. Obviously, you can't put that into perspective. But if it's like a monthly stable amount, like every month it's 30,000, you can project that out and record it. Now there is something called embedded contracts, which I don't know if you guys will have any of that, but it would be possibly any contracts you have out there that are, so almost like, for argument's sake, let's say like your cleaning lease. Like you had a cleaning lease, and within there was some sort of like, amount that you're required to pay, like on an annual basis. Like this is very hypothetical, but because I'm doing a big airport, and so airports have like these big embedded leases. So you kind of have to think about everything, what's out there, because you just might not think about.
What was the abuse that led to 38?
It's just not showing other liabilities that are out there. Like people have these especially think about building leases. That there's a significant amount of leasing of property in the government/GASB world, and that liability is not being reflected unless you've physically gone out and gotten like a lease with like a bank. You know what I mean? Like sometimes you can see them when they will be physically recorded, but you all you have you're paying. I don't know who you pay. Who do you pay here?
It's just a footnote before.
Yeah, just a footnote.
Just a footnote, but nothing tied to any of the financial statements.
Yeah.
That's interesting.
So we have some time with it right now. So it's kind of crazy because I'm going through this with another very large. They have 250 leases, and they say if you have over like 5 leases, you should get software. You should have some sort of software helping you out with this. But it's still pretty early because the FASBs are still going through this. So they're required to be implemented by the end of publicly traded companies, the end of 2019, and everyone else the end of 2018.
So ours is.
So you still have all of next year. It has to be restated as of 1/1/2020. But everyone's kind of behind. So especially the software companies, we're finding out a lot of them haven't even started going through this process. Luckily, you guys have 2. I think it will be a spreadsheet. It'll be an Excel document. And again, it always comes down to the materiality too. Like if we determine, I know this one's I know you guys have a pretty
2023.
Yeah, but I know you have a pretty decent
Lease.
size lease here. Yeah, so I don't think we're gonna be able to say it's immaterial. So you'll have to record it. So, but I will probably the next couple months get more kind of like presentations together and be able to provide you guys a little bit more guidance. Yeah. So
I'm sorry, Mandy, this is for next year's audit?
2020, yes. But you have to start the process of gathering the stuff.
Okay.
Because that's the biggest kind of like, yeah, it's figuring out, do you have anything, sitting back and being like, okay, is there anything else in here, any other kind of, and I don't think you guys kind of run into that. I think you're going to have like maybe equipment stuff and then the building leases.
Okay.
Will be the only thing you guys probably have out there.
So that includes Culver City and
I was thinking
whatever.
Culver City.
And let's just say it would be the opposite side too. This is leasee and lessor. So if you were leasing out any space it would be a flip side. So I don't know if you're doing Culver City, you don't own the building, so you,
Sub- our
Yeah, but we were
sublease is
subleasing,
Sublease,
and
yeah.
we got rid of it.
yeah.
Let's not get it back.
No, it's gone. Okay.
I think I remember what that was.
But so it's just something to be thinking about next
Okay.
couple months. We will definitely be helping you all with this, providing you guidance as I get. I right now have the 50,000 foot overview. I have people that have been helping me that know like the intricate details. So, but I will keep you guys posted.
Okay.
Okay, and then just finally, as I always like to wrap up, just thank you to all the staff. You know, you guys make our lives much easier when we come on site. Everything's ready. You know, you get everything to us ahead of time so we can request samples. Thank you. Thank you, Becca.
Yes.
Where are they
Yes.
hiding?
Yes.
Our fiscal services team has just been awesome. So thank you, Lori and Oksana and all of your team. You guys have just been fantastic, Sandy. Thank you.
Thank you for doing this. So we wrapped up this audit. We'll be back soon starting the next audit.
Seems like you never leave.
Right. And this one,
don't.
I think,
don't, right?
I think
This one
because of
doesn't
the
feel it.
timing, it feels like
Yeah.
you guys have just been here all year.
No,
Yeah, with the delay, right?
Yes, yes.
We've been talking a lot, so.
Well, we just want to thank CLA and Mandy and her team because we really extended this out from November. Usually we have the board meeting in November where we don't
Yes.
see them until they come back in March. But
Mhm.
we've had to just keep in contact, always go back and forth, try to get the information for these last 4 or 5 months. And it's challenging at sometimes, but you know, they were putting up with us.
I think a couple of times I said, I'm not used to talking to you during this month.
I know. Why am I talking to you?
Excellent.
Great.
Any other questions, comments? All right. Next week,
Okay.
item 5. Don,
Is
is
that-
this
is that you?
your cue?
No, we're gonna let Lori take this one.
Oh, this is one, okay. I will, if anyone needs anything, I'll be outside. I'll be in my new office in the back. I'll stop by and say before I leave.
Okay, so the next item up is, we were gonna have a discussion on the audit services contract. Now, we've had Clifton Larson Allen since fiscal year 2011, 2012.
Mhm.
And at that time, we entered into a 5-year agreement, for services. And when that was coming due, we had a discussion about possibly extending them. At that time, we were very happy with their services. High quality audit, reasonable costs, and we really felt that they were, you know, helping out the agency and giving us good quality, feedback on how we could improve. Here we are again. We had a 3-year extension that does expire at the end of this year. So
Calendar year?
end of this calendar year.
Okay.
The contract is good until December 1st, 2019,
We did,
it does include-
extend at the end of 7?
2016.
For 3 years.
2016. Yeah, for 3 years. And so at that time, we did save, or save the agency close to 17% in audit costs at that time. And come forward to this year, we're in the 7th year of it, the 8 years. And we, again, were able to negotiate with them a possible extension for another 5 years. It would be 4 years with an option in the last year. It would be fixed flat rate, fee for the remainder of the 5 years. And, I do have a little bit more in details as to, the cost. I mean, for the first 5 years, compared to the proposed 5-year, contract extension, we would be saving about 100,000, a year,
That
since
much?
the beginning.
So we got them to cut
We got 'em to cut
15% on this
15%.
proposal, so in essence, you've got a 30% reduction in audit costs since 2016's negotiation.
They're
That's
excellent
really good
negotiators.
rate.
Isn't he?
Right.
Wonderful.
I know. And you know what, and I think that normally you expect audit costs to incrementally go up every year, like they do, but this one is not, it's going down, and I think that it's really a story or a testament as to how they value us as a client with them. They know that we are getting leaner and meaner, and they know that they know us fairly well.
Yeah.
And, you know, I think that sometimes questions come up as to, should we be looking at changing the auditors? You know, some people do naturally just want to rotate their auditors. But there's publications out there that says, is this really a good thing to do? Because you've got a new auditor coming in, and that's when there's the biggest risk. You got someone new coming in, they don't know you as well, and they may opine on something that's not necessarily correct. Whereas staying with somebody for a longer term, you know, it's to, I mean, especially with Cliff and Larson Allen being who they are, they're there to, you know, really look at all of our ongoing programs, look at our new programs, and make sure that we are, you know, following all the rules as required. So
I think they've demonstrated not only a commitment to us, but I think, you know, they really hold the team to
Accountable.
the fire.
Yeah.
They're very, I won't say eager, she seemed a little eager.
she seems a
about,
little eager to find.
You have finding another finding next year, but
I was like,
think
come
that's
on,
good.
man.
I think it's a good thing because it keeps us on our toes and makes us, you know, be on our A game at all
Yeah,
times.
I have to tell you, I think they've made us a better agency.
Yes.
I mean, when because we had heard when we kept asking asset management over a 3-year period, what is going on? They kept telling us we need more staff, we need more staff, we need more staff. And you remember
I do.
that they kept coming in and saying, well, we can't get this done within these timeframes because we need more staff. And Mandy literally took me aside and said, they're lying to you. You need to do some digger deeping because something's not right. And she said, and she was just like, this is not looking right. And so to be able to say, you have some yellow flashing lights, and to be able to have an auditor be able to say, go look at that, because
Right.
I genuinely appreciated
Yeah.
hearing that and saying, and then it did allow us to go dig a little deeper. And we frankly did not have policies and procedures in writing.
Yeah.
So we had asset managers which were each doing something a little bit differently. So it literally did make us a better agency, because then it allowed asset management to work with fiscal services to establish those things. So it really did, I think, helped us to be a better agency, because it shined light on areas that had been covered up for years.
Yeah, I mean, that's the beauty of a good audit, when you can
Yeah.
operationalize the findings.
Yeah.
As opposed to just have it be a fiscal analysis
Yeah.
of where you are, you can translate it.
Yeah.
I ascribe to the position that you can't get too comfortable with your auditor,
Yes.
because then you don't have that checks and balance that you need. So I am a little hesitant about a 5-year extension, although I believe that the discount is significant and it's important. And I believe in the team and the agency in terms of being able to, continue this great track record. I think that we had a similar concern, and that's why we only did a 3-year extension the last time as opposed to a 5-year extension. Can you tell me the difference between would we get a similar discount if we only did a 3 versus a 5-year extension?
No.
No, it has to be 4 to 5 year.
Well, it's 4 with the 1-year option, so
Oh, it's 4 with the 1 year
4 years
option.
with the 1-year option, so.
Okay.
And I think, I can only speak for myself, but when I came in about 2015, and for me, I didn't know them, right?
Right.
So when we came with the 3-year, proposal, part of that was, I think, for me, getting to know them and seeing what kind of quality audit firm they were.
Yeah.
I had not having experience with CLA prior to that. So I think now we're here, and I think we're at a different comfort level, because we've had 4 years pass by at this point, in terms of at least my understanding of what they do. And I think the staff have been very happy with the relationship that they've come to have with CLA. So I think that's why we went down the road we've gone in terms of the negotiations so far.
Well, I would certainly be comfortable with the 4-year, with the 1-year option, knowing that, she is changing the team and, bringing in new team members, because, it's always important to have new eyes on a process, or new eyes on, whatever amazing work you do. It's always good to have a new critical eye on it.
Yeah, and
So-
they did introduce, well, Iffy is new. She did come up for a little bit, but she's fairly new on the team. But she did say that she's gonna introduce Gabby this year.
Right.
Right.
Yeah.
So
she
that's
was
how they do it.
mentioning
They
that.
do do the rotations.
I like that, I think that's a good
Well, also they've
practice.
rotated in the course of this time, they've rotated their review partners at least once that I know of in terms of the second
Nancy.
review. Cause we used to have a different partner that was on the engagement, so Mandy's the newest partner on the engagement.
Mhm.
And we've had some switch outs in the team, like at the staff level as well, so it's
Like
not
we
always the same.
previously had
We have some
Nancy
continuity.
do the second review, but this year it was another,
Person.
principal.
Okay.
His name, I
It's
think,
a fresh
I
pair of
believe his
eyes
name
on
was
it.
Dave.
See, and I like that, I think that's great. So as long as that practice stays in place, then I think I would feel more comfortable knowing that, you know, fresh eyes are looking at our people.
Anything else to add?
No? We have any
Mr.
more
Agee,
questions?
any thoughts?
No, I mean, I think for us, it's, you know, it's one of those things that's, it's not broken. You know, don't try to fix it, and it sounds like, for the most part, your concerns have been resolved, at least understanding that we're talking about 4 with an option. So for us, I mean, I think we're still getting acclimated with everything we've heard thus far. Doesn't seem like there's a need to deviate, so.
Mr.
Good.
Gunning?
Good, do we need a motion or anything, or?
I think we
it's a
do.
good deal.
Yeah, no motion?
Leave it to fine negotiation.
Let me not sit across the table from you next
I
time.
know.
$100,000 discount.
Alone, right?
Yeah, I'm laughing.
Oh, congratulations.
Thank you.
Great, seeing no other questions or comments, I think we now.
I think one what we're gonna try to do, during the last board meeting, we had, I think it was board member Sotelo and board member Gallagher who talked about, fiscal disclosure, training, some of the other, was there
There's
some?
an update on the derivatives, the swaps, and all the
Yes.
our situation with that.
And so we were hoping that we would be able to do some of that during the audit meeting, but we couldn't pull that together back quickly enough. So Melissa, were you saying you wanted to try to do that in May at the
Yes.
May board meeting? So we'll do some of that disclosure training, and update on some of the derivatives and some of those things at the May
Where
board
we are,
meeting.
where we've been, all
Yes.
that sort of stuff,
Mhm.
perfect,
Yes.
that's helpful.
And that'll be the
Especially
same
with this
meeting, that'll be the same meeting that we have the business plan and budget as well. And
Oh.
we'll keep it as efficient as possible so it doesn't turn into a huge meeting, but I think we should be able to cover both at the same time.
Would be worth it to have that discussion.
It's a good discussion. Okay, anyone from the public want to comment? So it's your chance.
Great job, everyone.
Oh, sounds good, Natalie.
Awesome, good job. Okay, any more comments? Seeing none, we're adjourned.
Thank you.